in case of certain units, the debt equity ratio may be above this benchmark level. In such cases, benchmark level, there is prescribed a benchmark level, but at the industry level is beyond that level, beyond the level of the company. In that case, the finance can be very well considered. Just to make you understand this position, I will just to explain this, I will just show this illustration. Kindly have a look on this one. Here the ABC Limited, that is the name of the company, and it is a industry average. That first year, there are 2 years position is given. This unit is engaged in the shipping activity. So the ABC Limited year 1, year 2, both the years position is given. So we have taken out from the balance sheet what is required by the bank to analyze. Yes, what is first item is total investment. You see the first year the company is concerned, it is 100 crore. The industry, average industry level is also 100 crore. And the second year it is 100 crore, again industry average 100 crore. There is no doubt about it. Okay. Then what is the total debt of the company in the first year? See, 80 crore is the total debt. For industry average is 60 crore. And the second year it is 80 crore is the total debt. Industry average is 60 crore. Then what is the equity? Equity is 20 crore so far as the company ABC Limited is concerned, and industry average is 40. Then second year is also 20, industry average is 40. Then what is the debt equity ratio? Debt is, we have found that debt, total debt is 80, as against that the equity is 20. So the debt equity ratio of ABC Limited for the first year is 4, and the second year is also 4. But the industry average, so far as the debt equity ratio is concerned, it is 1.5 in the first year and second year also 1.5. Now coming to other part, the third one, this is the fifth item is the profit or total funds employed. That is the total earning. What is the profit of the company, or what is the profit of the industry average? Here the company has made, company's percentage, one company's profitability is 15%, and industry average is also 15 in the first year. Second year the company's profitability is gone down to 9%, and the industry average is also 9%. Both are at par in the second year. Okay? And profit before interest, because here we are analyzing the profit before interest. What is the profit? Here the first year the company has made a profit of 15 crore, and the industry average is also 15 crore. That average profitability is 15 crore. And the second year it is 9 crore, and industry average is also 9 crore. Then what is the interest, rate of interest on these outside funds or the debt? That is 12% is being considered. The company has paid 12% on the debt. It comes to the first year it was 9.6 crores by way of interest the company has paid, and the industry average is 7.2. Industry average is lower than the company's interest burden, and the second year the interest burden is same, that is 9.6, and the company average, the industry average is 7.2. What is the balance profit? The balance of profit available. Here you see what is the profit available? 15 minus 9.6. That is the profit, available profit is 5.4 crores. Second year it is 7.8 crores. So far first year it is 5.4 crores, and so far as the industry is concerned it is 7.8 crores. Average industry level we are giving the we are taking the industry average. As against the net profit, of 5.4 crores earned or made by the company ABC Limited, the industry average is 7.8. And the second year, on the contrary, the ABC Limited has made loss, whereas the industry average, industry has made a nominal profit of 1.8. Industry average shows a nominal profit of 1.8. Then net profit available for dividend. In the first year, how much? See, income tax. Out of this 5.4, the ABC Limited was required to pay 50% by way of income tax, and that comes to 2.7. That is 5.4. The 50% of 5.4 comes to 2.7. So 2.7 is an outflow by way of income tax liability, and in the industry average comes to the rate remains the same. The industry average comes to 3.9. So what is the balance available in the first year for the company for declaring this dividend? That is 2.7 crores, and the industry average is 3.9 crores. In the case of second year, in fact, the company has made the loss. So the company has made the loss, whereas the industry average shows a nominal profit of 1.8. And the income tax on that one, the industry average 9 gone, 0.09 gone, the 9 gone, then there is no liability on the company's part because it has made loss. The net profit available, as we have seen, first year is 2.7 for towards dividend payment, and industry average 3.9. The loss, there is no dividend, and industry average 0.9. And yield on equity. How we are working out yield on equity? That is the net profit available divided by the equity. Equity is 20, and the first year you see net profit available is 2.7, and 2.7 divided by 4, that gives 13.5%, that is the profitability or yield on the equity. 20 crores is equity, equity yield is 10.5. Here the debt equity ratio is 4, whereas the industry ratio is less. Industry ratio is 1.5. Still, this unit has made profit to the extent of 13.5. Whereas in the second year we see it is loss. Unit has made loss, so there is no yield, whereas the industry has made a nominal yield of 2.25. Out of this illustration, this data, what inference we can draw? See, in the first year, even though the debt equity ratio DER is 4 is on the high side so far as a large industry. Even though the debt equity ratio is 4, the yield on equity as a percentage is larger as the profit of the total funds employed is higher than the interest cost. What is interest cost here? Interest cost comes to 9.6, whereas the yield on equity is 13.5. Yield on equity as a percentage is larger than the profit on the total funds employed is higher than the interest cost of the debt. That is a first inference. There is in the second year, on the contrary, or second year, the profit on the total funds employed is lower than the total cost. In the second year, the unit has made only 9 crores. That is lower than profit employed is lower than the total debt. The high DER dragged and pulled down the yield on equity. There is no yield on equity because the unit has made loss. And again, another inference is that the company with high DER in the second year would incur net loss, although the industry as a whole made a nominal profit. These are the inference. What we were telling, yes, even for higher equity, here in the first year we see the debt equity was higher on the higher side, that it was 4. Even though it was 4, the unit could make profit, and the yield on the equity or yield on the investment is much more than that of the cost of the funds. This is what the inference we could draw from this illustration. See, another ratio under this capitalization or leverage group or leverage section is funded debt to equity ratio. This ratio shows or indicates the relation between the term liabilities to that of the equity. It has more relevance in the case of new projects. For financing the cost of the project, the source is either the equity or the funded debt. The owner should have a reasonable stake in the business, that whether in that project, whether the adequate provision, adequate contribution has been made or not. This is what the inference we can draw from this ratio. This owner should have a reasonable stake in financing an enterprise. This is a second ratio. Then third one is debt to service coverage ratio, DSCR. This is calculated to assess the repayment capacity of the unit out of the internal income generation. It is calculated at the time of sanctioning of the term loan. How it is calculated? It is calculated by net profit plus depreciation plus interest on term loan divided by interest on term loan plus installment of term loan. This ratio, the ideal ratio, so far as DSCR is concerned, it is 1:5. That is, it indicates that its income generation is 1.5 times more than the required level. This ratio indicates the measures of safety in repayment of installments and interest as and when due. Decline in ratio means that income generation is either less in the initial years or sometimes it is less. In that case, what we can, as a banker, what we can do? The decline in the ratio means drop in profitability or overambitious projections. Projections may not be realistic at the time of submission of the proposal, or insufficient management also. It may be possible that at the initial years the ratio may be slightly lower. In that case, as a banker, what banker would do? Banker has taken a decision to finance the project taking into account all the parameters. Yes, if the DSCR, debt service coverage ratio, in the initial years indicates as a lower level than the ideal one, then bankers can stipulate that lower repayment in the initial years and installments can be, the amount of installment can be stepped up in the later part of the repayment period. That is one way. In another way, suppose if the ratio is higher, is more than 2, 1.5 to 2, it is taken as ideal, but ideal, the benchmark is 1.5. If it is beyond 2, that indicates that its income generation is much more. This is 2 times, is more than 2 times of the required level. So that shows that gives an indication to the banker also. Yes, he has got the adequate income. It can be, so our due should be, our fund should be called back. So the repayment can be either reduced, the period can be reduced, or the amount can be increased. Thereby, the bank can, suppose a term loan is given for 7 years. If the ratio indicates that beyond 2 or more than 2, the bank can consider the reduction in the repayment schedule, repayment period, or increasing the amount of the installments. These are the 2 indications. If it goes down, yes. If the level is, if the DSCR ratio is lower than 1.5, we can stress it, the repayment period can be stressed, or in initial period the repayment can be, the amount of repayment, amount of installment can be reduced. And the second case, in the case of ratio is more than 2, is more than 2, the repayment can be stretched, the period of repayment can be reduced, or the amount of installment can be increased. Well, the third group of this ratio, that is activity ratio. Activity ratio, as I told you, there are 4 types of activity ratios which are being analyzed by the banker. The first one, that is inventory turnover ratio. And before that, I tell you what is actually activity ratio. That is, here the analysis is mainly confined to whether the inventory management is up to the mark, whether the receivable management is up to the mark, whether this inventory, receivables and working capital management is up to the mark. This is a basic thing this a banker would generally normally analyze while going through this, while undertaking or while doing this exercise of ratio analysis in respect of ratio of activity analysis of the activity ratios. Now coming to inventory turnover ratio, what does it speak? This ratio, that is inventory turnover ratio, indicates the level of inventory or stock. When I say the inventory, that comprises of raw material, stock in process and finished goods. These 3 items and other consumables also, these are all coming under the inventory. So this, whether the inventory or stock is the same, in another word we are using it, inventory or stock. Whether the level of inventory or stock or and in relation to annual consumption. The inventory stock holding should not be too low. That means in case of emergency, the unit will find it difficult to arrange for the raw material. Suppose in many units, the critical raw materials, they hold it, they keep in stock at least for 15 days, 20 days or 1 month or 2 months, like that, depending upon the time required for getting this or procuring this from the market. So if it is too low, that is not good, and if it is too high, that means they are blocking the funds. The fund is blocked there, idling cost, then that is a hit to its profitability. Now if it is too high, it means, as I told you, it is not good. The large stock holding is a charge on the profitability, go down space, because if you are keeping more, if the unit is keeping more stock, yes, naturally it has to be stored somewhere. Storage, that storage space, that problem may arise, and carrying cost for transportation, for bringing it here. So all this, ultimately it is a hit to its profitability. So this ratio we normally analyzed on these angles. How it can be computed? There are 2 ways. One is the sales divided by the stock, or the stock divided by inventory divided by sales, which are multiplied by 100, then it is a ratio. Then what inference we can draw, or what analysis can be drawn by doing these formulas? The first one is sales divided by stock. The sales divided by stock, it indicates how many times, the number of times the inventory is rolled over, to that of the sales, rolled over or turnover. It's if the number of times or number of time is more, than more time, means more with a lesser stock, lesser inventory, it has increased the turnover. If it is less, then it shows otherwise, that inventory holding is more. And that is, the more number of times, that more sales. And in the latter case, that is, if the ratio is on the lower side, if the number of times this turnover is less, the number is less, then in that case it is it is other way around. That means it is a inventory holding is higher than that is required. Then if we go as per the percentage wise, that is stock divided by sales into 100. If that is we are getting here also first method, by doing so, if suppose if we are getting a numerical, is the answer of 2 months. 2 shows that the unit is holding inventory for the inventory of 2 months of its consumption. If the latter case, it can be carried in the percentage terms, that is stock divided by sales into 100, and that shows that if we are doing that exercise, we are getting a percentage of 20. It implies that, or it is presumed that his stock holding shall be 20% of the sales. To have more realistic picture, more realistic view, we can, instead of taking the stock as on the particular date of the balance sheet, we can have the monthly this stock we take and the average can be worked out. That will give a realistic picture rather than taking the stock position as on the particular date or on the date of the balance sheet. This is regarding inventory turnover. Now, likewise, the same formula can be applied in the case of the various components of inventory. That is raw material, we can do the same ways, how much raw material is being turned over to that of the sales. Then similarly, stock in process, finished goods, then consumables, etc., to that of the sales. Then various type of inferences can be drawn by doing this analysis. Now the second one is debtors velocity ratio. Debtors velocity ratio indicates the number of times the debtors are turned over, rolled over during a year. Generally, higher the value of the debtors turnover ratio, the more efficient the management is, the debtor receivables management. If the more number of these, within the limited number of times it is turned over, that indicates that management of the receivable is efficient. Receivable management. It is calculated to ascertain the period. This ratio is being being calculated to ascertain the period of credit given by the unit to its clients, to their customers, in terms of number of days, number of months, number of years. Years normally hota nahi hai. Number of months, number of days, or number of weeks also it may come. Okay. So how it is being calculated, or how it is computed? See, the debtors velocity ratio is taught. There is sundry debtors, that is a receivable position, receivables, holding of receivables, divided by the credit sales. When the debtors will come only when the credit sales take place. Otherwise, if the sales are against cash, there is no question of debtors. The debtors will come only when there is credit sales. So total debtors divided, sundry debtors, total receivables divided by the credit sales into, if you want the number of days, into 3, multiply by 365 days. If you want in weeks, it is by 52, and if you want in months, it is multiplied by 12. Then you will get the ratio. Low debtors turnover ratio indicates poor management, and poor management of debtors, sales, and less liquid debtors. This is what the inference that can be drawn by analyzing this ratio.